Big tech companies have been on a roll in 2023, but it's time to take a look at a small technology company. And today I'm going to be going through Adeia. This is a small technology company that provides technology to help streamers provide the content on YouTube, on a variety of the streaming services, even old-fashioned linear TV. They license the technology to stream what they're doing from Adeia. It's a profitable company that I've been an investor in. I'm Victor, and I'm an active value investor. I have an MBA, and I have a lot of business experience. I've been analyzing companies and investing in them for some time, and I like sharing my analysis on YouTube. Let me share more about Adeia. I take all my investments through a process, and the process involves 4 questions followed by the decision whether to buy, hold, or sell a stock. First, do I understand the company? Do I want to be a part owner in the company? Do I like the industry this company is in? Second, is the company operated and performing well? Basically, what's the report card on the management team? 3, is debt under control? Does the company have a good balance sheet? 4, do I get a discount? At the end of the day, I want to make money. So if you give me a discount on the stock, I will make money over time. So that's a must have for me to be a buyer. And last, I make a decision whether I buy, hold, and sell based on the answers to the above questions. So the story on this company is quite impressive. They've been in this particular technology area for a long time, since 1990. So every generation of video or streaming, cable TV, all those things, they were a part of it. They developed the technologies that are needed at each paradigm for that to happen. And they are part of the most current paradigm, and they license their technology. What's nice is once they have that creative idea, they have a good copyright, they have good patents, and then they license it. So it's very profitable once they have a technology that other companies want. So I like that about the company, and I like that about the industry, that once these guys have really good IP, they can sell it and make lots of money. Let's get into their financials, but let me provide a quick note on this company. In 2022, they divested a business that wasn't part of this IP, royalty business, and therefore their financials don't line up perfectly year to year. And I'll provide more comments on that divestiture as we go through their financials. First, the revenue actually went down this year. It went from 138 million in Q1 down to 117. So that was a decrease of 15%. Never good to see revenue decrease. So I'm going to keep my eye on revenue. They were profitable, so that's really good to see. They actually sustained their profit, even though their revenues did go down. Let's take a look at their earnings per share. And I wanted to point out that on their last earnings call, they surprised to the upside, and it really caused a nice rally in the stock price. And they surprised to the upside. Analysts were expecting far less, and these guys surprised to the upside. This year, the analysts are saying 1.34, $1.34 earnings per share. Again, I think they're going to surprise to the upside because they're already at 89 cents per share earnings for Q1, Q2. So it's very easy to make up, what would be 45 cents. They could probably do that in one quarter. And next year, they're expecting $1.50. Again, analysts are expecting less of this company, I believe, because it's a small company and they don't spend a lot of time. A lot of these analysts spend their time with big companies. They spend their time on Meta. They spend their time on Microsoft, but they don't spend a lot of time on a little company like this. So I believe it gives small investors, individual investors, an advantage. I'm expecting the earnings per share to be more in the neighborhood of $1.78. For price to earnings, the price to earnings currently is 6.44, a super low PE on a technology company whose customers include Google, whose customers include Netflix. I mean, just a long list of these really strong companies are their customers. Take a look at their balance sheet. Their balance sheet's in good shape. They have $82 million in cash, and they have debt as a combination of about 646 million. Their debt to EBITDA ratio is below 3. They make good EBITDA, so they could pay off all their debts with 3 years of EBITDA, which fits the quality, low risk balance sheet in my book. Now let's take a look at cash flows. Their cash flows are really good. This is a business that doesn't have to manufacture anything. Once they have that technology develop, they just make agreements with customers. And so it's a very profitable, high cash generating business. They don't have to invest a whole lot in CapEx back into the business. Therefore, they had $63 million of free cash in the first quarter of this year. That's a 50% increase when you compare Q1 of 2023 to Q1 of 2022. I value stocks based on free cash flows, which is a majority of my valuation. And I also look at earnings per share. Let's take a look at cash flows first. Last year, they produced $170 million of free cash flow. I think they're going to more than do that, but I'm going to go conservative since it is a small company and just use 2022. Based on the free cash flows going into the future, I'm going to grow the first 4 years by 0%. I'm just going to go really conservative. And long-term growth, I'm going to say 2%. And based on those growth rates, a weighted average cost of capital of 9%, I expect that those free cash flows and the terminal value is worth $2.1 billion in today's value. If I add the cash on the balance sheet and take away the debt on the balance sheet, I get to an equity value of $1.6 billion for the company. They have a lower market cap. And if I divide the value that I calculated by the outstanding shares, I get a value per share of $15.07, but the stock is trading at $11.47. So it provides, based on the cash flow method, a 31% discount. Now looking at earnings per share, I'm going to take the low earnings per share that analysts are predicting. I expect the company is going to exceed that, by the way. And I'm going to take it times a PE of 12, which is a very reasonable PE. They are trading for less than that PE currently, and go just a nice low 2% growth rate on that. And the earnings per share method provides a stock price of $13.56, but the stock is trading at $11.47. So there's an 18% discount using the earnings per share method. I weigh the free cash flow method more than earnings per share. In fact, I take 2/3 of this valuation, 1/3 of the earnings per share, and I come up with a blended value of this company. You get a discount of 27%. When we look at year to date, Adeia is up almost 15%. But if you look at when they released their earnings, they jumped up 57% in 2 months. So it's a really nice rise in the last 2 months. I had done my analysis. I believed in this little company and bought shares leading up to that earnings release and have really benefited from that big rise over the last 2 months. The performance of the company, the stock price has been pretty good. It's not keeping up with the S&P, but as mentioned, the last 2 months have just been great. Profits are good, but revenues are down. Got to keep an eye on revenue because I'd hate to see a company just continue to go down in revenues. I want to see that revenue grow. Very good free cash flow. Love to see that. It's actually increasing year over year. The balance sheet's in good condition, and they pay a dividend of 1.7%. My guidance for 2023, I expect that they're going to have higher growth in revenue. They're going to continue to be profitable and generate that free cash. I also expect they're going to surprise to the upside in Q3. I think the analysts that cover this, they don't spend a whole lot of time in it, and it is very reasonable for them to exceed this quarter. It's a small IP company in tech, and I think the individual investor has an advantage because the big firms are not paying attention to this. If you listen to Peter Lynch, this was his recipe to finding multi-baggers and in stocks that would really give you a great return, is finding small companies that the big analysts are not touching because they're not paying attention to it. And once somebody does find it and several analysts start covering, a lot of people get into the stock and you see your stock price rise. They have a big addressable market. Let's face it, streaming is just huge. So these guys have a big addressable market. They need to grow their revenues. If in the next year, 2 years, they don't grow their revenues, I'm going to sell. I just don't want to be sitting on a stock that doesn't grow, because if they don't grow, somebody's going to replace them. They're not going to be relevant, and I'm out of the stock. So let's revisit my scorecard for Adeia. First, do I want to be a part owner in this company? And do I want to be part of this industry? The answer is absolutely yes. This is a developer of IP for the streaming industry. It's a good industry to be coupled to, and it's a very profitable business. It's a very high cash flow generating business. So I do want to be an owner of this company. I want to be in the industry. I give a nice check mark to the management team. I think they're operating the company well. I like the divestiture that they had in 2022. Getting rid of the part of the business that is not part of the IP is a good idea. Debt is less than 3 times EBITDA, so a good check mark on the balance sheet. You're offered a discount on this stock. And again, I think they're going to surprise to the upside in Q3, and the stock will pop again as they did at the beginning of the quarter. And last, I'm going to be a buyer of Adeia. It's one of the few stocks that I'm buying right now because I think the market's pretty overpriced right now. But this one I think is flying under the radar. So I am a buyer of Adeia. Thank you for watching the video. I appreciate it. I hope you found it interesting and discovered something new about Adeia. Keep in mind, everything that I do is for entertainment purposes only. This is not investment advice. I'm not recommending you buy this stock. I like sharing my experience as an individual investor. I like sharing my analysis, and I hope you found it interesting. Good luck investing in 2023.